everyone for joining. We appreciate you taking the time to join us on this webinar, our first of maybe many. Really depends how long this keeps going. Also want to thank a lot of you have been really helpful with feedback and questions that have helped us refine these reports, help us come up with different topics to discuss, and we will continue to put these reports out there as this crisis continues to unfold. Before I hand it off to Vadim, I just really wanted to give a little bit of an overview of the company. I mean, not really the company. Many of you are familiar with what we do, but I think, when I started the company 5.5 years ago, it was really kind of a moment like this that I had in mind, where I thought the old way of doing things was really quite broken. And in my experience as a mortgage trader during the crisis, it was really tough to get our hands on data. And then even if you have the data, really being able to derive any kind of meaningful insights out of it in a simple way. And that was really the impetus for dv01. And it's really, it's a proud moment for us and the company to kind of be here right now and fill in that information gap in the market. And whether it's you're reading reports like this, or subscribe to some of our different offerings, or just looking at securitization data, our goal is really to make this market, any market that we participate in, which right now consists primarily of online lending and mortgages, way more transparent and easier for everyone to digest. So if you have any questions, any suggestions, any feedback, we'd love to hear it. We will continue to add new data onto the platform. Obviously, the insight is more powerful where we have the data, and we pretty much have a good chunk of over 90% of the online lending market in consumer. A lot less than that in non-QM, somewhere in the ballpark of 30% of that market. And we could definitely use all your support as investors in lobbying other issuers to get their data on our platform, so we could continue to make these insights and all the information that we offer just way more robust. So with that, I also just want to thank Vadim and Wei, who've worked really hard on putting these reports together, along with Alex, who's made it look really pretty, but also just the whole company from bottom up has been involved in getting the data to this place where it's easy for us to kind of provide you with these kind of insights. So we're working hard to make this available. And if you have any questions or suggestions, please don't hesitate to reach out. We want to make this as useful to the market as possible. So with that, I'll introduce you to Vadim. And if you have any questions that you want discussed in the Q&A, which will be probably the second half of this, there's a Q&A button beneath. Feel free to put some questions in there, and we'll get to that probably within the next 20 to 30 minutes. Vadim?
Thanks, Barry. As everyone knows, the economy at large is facing an unprecedented crisis due to COVID-19. It's been over a month since it's been established as a pandemic, and its impact throughout the consumer loan space is well noted. Please note, ours was the first published report to cover performance of of consumer loans post-COVID-19. And dv01 is the only place where investors and stakeholders can find the daily information and robust tooling needed to conduct thorough analysis on these markets. We'll be going over various sections of the report, a full copy of which can be found on dv01.co or by contacting our sales team. And we'll leave plenty of time for Q&A, but keep in mind that we will be objective throughout this whole thing and won't be discussing any specific issuer performance. And if you're having any other technical difficulties throughout the call, please message us directly in the chat box, and someone will be talking to you shortly. I'd love to go through an agenda of our call, which is, again, to discuss the online market lending space and non-QM mortgages. In online lending, we'll be going through distribution of due dates as they're scattered across any given month. We'll be talking about normal performance trends around delinquencies and modifications. And we'll be going back in time to look at prior cycles of increased modification activity and how those loans ultimately resolved. We'll also go through the first wave of post-COVID performance that we've seen and do a deeper dive into some specific collateral characteristics and attributes. In non-QM mortgages, we'll be doing roughly the same analysis with slightly different classifications of performance. And before we go further, I'd like to talk about some of the terminology we'll be using throughout the call. For the purposes of our report, we define delinquency as any loan that was past due, but not in an active modification. In online lending, we defined past due as anything above 0 days past, and in non-QM mortgages, we defined it as anything above 30 days past. which is in line with the typical MBA definition of mortgage delinquencies. Now, we defined modifications as any change, whether temporary or permanent, made to the terms of a particular loan or its payments. Additionally, we also included any offers to temporarily pause or make any kind of temporary halt on loan repayments. In both of these types, borrowers must contact issuers directly and actually request a modification. They're not being offered automatically. The concept of payment impairment blends these two together, and it's any loan that is either in modification or delinquent. And finally, negative outcomes, which will be referenced specifically in analysis of hurricane-related modifications, were loans that, post that period, were either charged off or became delinquent. A brief overview of the size of the universe we used to create the report, which was comprised of over 1.7 million active loans with balances of over $19 billion outstanding today. All data is referenced through April 23rd of 2020 and only includes loans that provide information on a daily basis. And one important note here is that dv01 did not filter or select any loans out of this report. If the loan met the eligibility criteria, it was automatically included. And while we'll only be discussing specific attributes around loan grades and geographic regions in this call, in our full report, we provided a lot deeper collateral dive insights and for even more granularity, and to help investors and issuers gain a holistic view on the online lending sector, dv01 is releasing an anonymized and aggregated consumer unsecured benchmark dataset to be debuted very soon. Please contact our sales team at sales.dv01.co for further information. And now, on to the performance trends. As we can see, loan due dates are not consistent throughout the month, but are rather heavily concentrated around the early days of each given month. This will become important in understanding the spikes in impairment and payment activities that we'll be talking about shortly. And as it should come to no surprise to many of you, impairments have certainly increased on consumer credit since the start of COVID-19. The tone of that increase is about 10 to 11% above historical rates. Now let's put that into some context. Early forecasts for April unemployment rates suggest unemployment can reach well over 20%, which would be a 16.5% increase from pre-COVID-19 rates. And there's been over 20 million, actually this week, now nearly 30 million initial jobless claims filed, which also represents about 20% of the total labor force outstanding. And that tells us that thus far, consumer impairment rates have been substantially below the change in unemployment. Now, this is a really important factor to note. Some of the biggest criticisms about online marketplace lending had been the idea that these loans had never seen a recession, and that during an economic downturn, these loans' performance would absolutely crater. The fact that thus far, not only have they not cratered, but they've been below the change in unemployment is a very positive signal, and not just for investors in determining ultimate losses, but for the marketplace lending space as a whole in being established as an established lending market with clear borrower payment priorities. Additionally, something we've noticed is that after the initial spike of impairments seen in early April, the rate of increase in total impairments has actually gotten slightly flatter. And we'll see this a little bit more in the next slide, talking about new impairment rates. So obviously, new impairments peaked in early April, as we can see in both of these charts, around the time of the early due dates we noted earlier. And since then, that rate has significantly plateaued. The next day that dv01 is anticipating in terms of major changes in credit performance will be in early May, as we see the next cluster of loan due dates approach. Now, we want to break down the impairment category into the two categories we mentioned earlier, which is delinquencies and modifications. And these two buckets have substantially different rates of performance. As we can see, while delinquencies did rise initially, they've actually been on a substantial downward trend since early April. While modifications have gone from representing a very small portion of impairments, they were well under 1% before the crisis, to now representing the vast majority of them, nearly 75%. Now, as we'll be discussing in later sections, modifications should ultimately substantially reduce investor losses and improve performance. And as we saw earlier with impairments, modifications have similarly had a slowdown in new rates ever since the spike of early April. Now, there's something important about this, which is that a loan can't become delinquent until it hits its due date by its very nature. But borrowers can be modified at any time, including before their loan comes due. And that's why we see some of the initial spikes post-April as borrowers are getting in front of their coming due dates and resolving their economic hardships. So while we talk about modifications as a whole, it's important to understand the composition of modifications and how they've changed over time. And what we see is the vast majority, well over 90% of all modifications today, are a form of extension, forbearance, or skip payment plans, all of which are common definitions used by different issuers. Now, these offer borrowers a temporary pause on making loan payments for a period of 1 to several months. However, the shortest of these programs, meaning the 1 to 2 month programs, do have features in place allowing for automatic extensions if economic hardships continue, as we know they are for borrowers today. So now that we've spent a little bit of time looking at performance to date, I'd like to take some time thinking about what modification behavior could look like once borrowers actually resume normal payment. And it's important to note there's been no precedent of loan modifications done on this scale before nationwide. However, there are some specific areas in which modification spikes occurred as a result of drastic and sudden changes in economic activity, most notably the hurricane regions surrounding Harvey and Irma from August to November of 2017. So to analyze those loans, we divided the entire universe of the hurricane-affected region into 6 categories of loans, depicted on the right, going from borrowers that were current and never received a modification, to borrowers that were current and did, and then every other major delinquent category in between. And from there, we looked at performance over the course of 15 months after the borrower received modification, or 15 months after any given time period. And that allows us to significantly determine borrower payment behavior once their short-term modification has rolled off. And here we can see the results of those outcomes. Should come as no surprise, the best performing loans were obviously those that were current and never received modifications. But those borrowers that were current and did showed an overall negative outcome rate of 26%, again defined as loans that were either charged off or delinquent. And while that 26% number is high, certainly higher than loans that weren't modified, it's nearly 3 times below the negative outcome rate of even the earliest delinquent bucket, to say nothing of the later buckets. And a little bit further analysis on this concept. While mods haven't ever been offered region-wide, they have been offered before on a micro level, borrower to borrower, to address things like temporary job loss, divorce, etc. And what we strove to do is we compared loans from the same time period, August to November 2019, the same universe, just in regions not impacted by hurricanes, to see what the performance of borrowers looks like then. And what we can see is there are generally pretty consistent trends in all categories except those loans that were currently modified. And we can see that modifications offered en masse in regions suffering temporary economic hardships have a substantially better rate of negative outcomes, almost 1.6 times less likely to have a negative outcome than modifications offered specifically to borrowers. The caveat here, of course, is even the 43% negative outcome rate for modifications in non-hurricane impacted regions is still almost 2 times less likely than the negative outcomes of a borrower simply going to. And to that same tune, we want to talk about some of the early trends that we have seen in loans that experience their first COVID-related behaviors in March. Remember, the crisis really started to manifest itself just around the periods between March 16th to March 18th. That was a time where we really started to see the first major spikes in performance. So what we can tell is that thus far, figure 7.1 is showing us that of all loans modified during COVID, just over 3% have made some kind of payment since their modification. Overall, that number isn't high, but when we break that down into the week at which their modification was offered, we can see that the earliest loans actually have a payment rate of just near 12%. 12% also not a crazy high number, but let's again keep in mind, these modifications are short-term, and the ones that are the shortest, the 1 to 2 month loans, do have built-in automatic extensions if economic hardships persist, which, as all of us know, they certainly have. So the fact that 12% of borrowers have already made a payment, despite the fact that basically all of them don't really have to, is actually a very positive sign for future repayments. Now, shifting gears into understanding some of the nuance of performance, one of the things we started to analyze at dv01 is how different geographies have responded during COVID. It's no shock that certain regions have been impacted significantly more than others. And we identified the states of California and the New York tri-state area as regions that imposed a particularly strict, wide-ranging, and all-encompassing quarantine efforts and did so much earlier. And as we see, their results or performance is slightly worse in those states. We also identified regions that have above average exposure to employment in the oil and gas sectors, notably Texas, Oklahoma, Alaska, North Dakota, and Louisiana. And those also have above average performance trends of impairments. But the states that have shown by far the worst behavior have been states where tourism and leisure activities play an outsized role in the employment sector, and those being Florida and tourism-specific states of Nevada and Hawaii. These regions have shown by far the worst payment impairment behavior as a testament to just how much those sectors have been impaired by the COVID crisis. And while it's important to understand that the quarantine efforts have been made statewide, the ultimate recovery from these efforts won't be statewide level, but will be very specific to cities, metropolitan areas, and even zip codes. So for investors to clearly understand what their portfolios will look like, they'll need to do deep dive analysis through some of the tooling and functionality offered at dv01. And we'd like to conclude the marketplace segment by talking about some of the performance by different grades that we've been seeing. After all, the marketplace portfolio is not, from each issuer, is not just one portfolio, but is a composition of multiple types of loan grades, which represent borrower risk profiles, different interest rates, and potential or likelihood of defaults. Now, each issuer does grading differently and uses completely different methodology, but to create an apples-to-apples comparison, dv01 employed significant heuristics assumptions to group all issuers into 3 distinct grades. Top grade loans, representing the best risk profile and lowest interest rates borrowers, to the bottom grade, which represents the exact opposite. The behavior we've seen related to that is that top grade loans have had by far the lowest increase in impairment rates. And we're even beginning to see a slow flattening in the total rate of impairments in those grades. The same can't be said for the bottom and middle grades, which have had by far larger outsized impacts on impairments. And I'd like to end the marketplace segment there and now move into the non-QM world, where we will again discuss the size of our reported universe, comprised of over 20,000 loans and over $8 billion of notional outstanding. Now, mortgages, as a lot of you know, don't report on a daily basis and rather report wholesale on a monthly basis. So the reporting ends on March 31st, and the insights aren't quite as current as what we saw in the marketplace universe. Some of the overall statistics on this universe can be found here, but the one I want to highlight significantly is that the percentage of loans in this marketplace universe that have either some form of purely stated income, no income verification, or limited verification is exactly 0. Today's non-QM is not the non-agency loans of the previous crisis. And to better understand just how much these loans have changed, and for an overall perspective on the non-QM market, investors and all stakeholders can leverage the newly formed non-QM benchmark dataset that is now available through dv01's market surveillance offering. Again, please contact our sales team for more information. Now, the payment impairment trends we've seen in non-QM suggest that impairments have grown by 1.1% in the month of March to a total of 2.6. Again, let's compare that to unemployment, where we saw about 10 million initial jobless claims filed in March, or 6% of the labor force, and a 3.5% change in impairments in the NPL sector. So overall, non-QM really has hung in. Now let's think about this again in the context of the previous crisis. Back then, mortgage delinquencies and impairments rose by a factor higher than overall unemployment. And that was the overall mortgage universe, including agencies. The non-agency market, specifically subprime and Alt-A, increased by a multitude of factors above unemployment. And a lot more detail about this can be found in our overall report. So the fact that thus far non-QM is hanging in as it is should be an initial early positive sign for investors. And in MPL, one thing that, in mortgages, one thing that we did was we broke down impairments into a rate of new impairments, which we see here, offset by almost 40% of loans going from a delinquent status to current in the month of March. Well, let's keep this in mind that even in these dire economic circumstances, if you recall, COVID was declared a pandemic all the way on March 6th. Non-QM borrowers are still attempting to significantly manage their payments and stay current on their loans, which is far different than the prior crisis. And even more importantly, that cure rate is largely consistent with prior months. Now, the same analysis we did in Marketplace applies here, where we noticed that delinquencies, that there was both a rise in delinquencies and modifications in this period. Again, thinking back to 2007 or the 2008 credit crisis, when delinquencies really started to rise in 2007, but full-scale modification efforts weren't in place until HAMP was established nearly 2 years later. Now let's think about that today, and servicers have already created modification programs to help borrowers in economic crises. And we'll conclude on some of the deep dive credit characteristic analysis similar to that we did in my Marketplace universe. There's no concept of grade in non-QM. However, we can clearly see that looking at performance by FICO, we see some substantial spikes, well over 2%, in loans with credit scores below 700. But those with scores above 740 show virtually no change. And we do see some similar trends in LTVs, with the over 80 LTV bucket spiking the most. But unlike FICO, all the buckets have exhibited some form of impairment increase. And we'll conclude the non-QM segment with the analysis of the same geographies that we covered in NPL, with the major caveat that oil states and tourism states aren't significantly represented in the data set and couldn't be individually isolated. But what we have noticed is that Cali, Florida, and the tri-state are actually performing slightly better than the rest of the country. But it is still fairly early. This is still March data, so we're waiting to see more before we conclude any definitive trends. So to summarize our overall findings, we find that the online marketplace lending space has thus far disproved the notion that the sector would significantly underperform in a downturn. This downturn is as substantial as anything many of us have ever seen, and thus far the loans are very much hanging in. In non-QM, there's clear differences between today's non-agency loans and those of the previous credit crisis, as performance thus far is showing. And the overall trend in consumer credit is that despite the fact that COVID did not choose any of its victims and has impacted the whole country, it's still clear that underwriting standards will play a major role in understanding credit performance. This concludes our prepared remarks, and we'll now turn the floor over to Perry for questions.
All right, thanks, Vadim. So we got a few questions in the chat, and again, if you have a question, at the bottom of your screen there should be a Q&A section where you could put it in. And so we'll kick it off. One's a little bit more specific to the application. So on the dv01 app, what are you treating as quote unquote modified loans in the strats? Is it both modified status equals modified, and modified status equals previously modified?
We're treating active modifications are only those loans that have a status of currently modified. Previously modified means the loan was modified at some point, but is no longer an active modification. In other words, any loan that was previously on an payment impairment plan that is no longer on one is now considered previously modified.
Okay. How does your impairment data consider automatic enrollments in hardship programs, say after an account misses their payment?
So the indication that we've gotten from a lot of the issuers that we've contacted, and we speak to them on a daily or weekly basis, is that automatic enrollments are not being offered right now, and borrowers still do have to contact the specific issuers and servicers to indicate that they have hardships and request a modification. Now, that is still right now based on request basis, but it is still something that the borrower has to do proactively. So there is no automatic enrollment that we've heard of thus
far. Okay. Another one that we got, during the 2017 hurricane season, how long after the pause did it take for borrowers to resume paying?
So this is one of those areas that's a little bit tricky to answer, and this is the reason that we actually used a 15-month payment window to really fully, give a substantial amount of time to see borrower behavior post. The vast majority of these programs that allow borrowers to skip payments are short-term. They're 1 to several months, with some built-in extensions in the 1 month period. What we did notice is that total modifications plateaued after November 2017, and a lot of modifications began payments shortly thereafter. But it's hard to say exactly when one borrower stopped and when another stopped because of the fact that the short-term programs, even as they are, can be extended. But that 15-month window gives really about a year or more of borrower payment behavior post-modification.
Yeah, I mean, the work into the hurricanes is really key, but not a perfect barometer, but really the only data point that we could look at.
Yeah.
So another question that we got is that Kroll recently downgraded ratings of unsecured consumer loan securitizations across broad issuers. What's your observation about the primary drivers of the downgrading?
I mean, it's no secret that payment impairment rates have certainly gone up. I think there can be concerns that a lot of these impairments will become delinquent, but we're hoping that by understanding some of our payment impairment trends, understanding how modifications can perform, and once we start seeing more behavior, we can get a better sense of what the ultimate losses in these things can be. The one thing that we do know is a lot of these securitizations were structured with substantial protections, particularly for the senior most class. We know that the senior class has typically had enhancement rates of about 35% or more, even excluding excess spread. So it's still early to say what ultimately performance is going to look like. We're seeing that most of the borrowers are going into a form of modification rather than delinquencies. So really a bit early, but the amount of enhancement present in the deals, the feature of excess spread, and the fact that these are generally pretty short duration loans, only about a year duration, is going to give a lot of protection, particularly to that senior class.
Yeah. And I think it's important just to note that, when in the closing remarks, when we say that the online loans, are not significantly underperforming in the downturn, that doesn't mean everything's positive. I mean, it's still a pretty bad situation overall. But I think, just in my experience over the last 5 years, when we started dv01 and I, became familiar with the online lending sector, I think there was just a general skepticism that even a mild economic downturn would result in pretty significant delinquencies and people would just walk away from the loans. And I think if there's anything that we're sure of, just based on the data that we've seen, is that hasn't happened, that people haven't just walked away from the loans. and stop paying immediately. They've been receptive to modifications. Now, at the end of the day, whether or not those modifications work, I think is more of a function of the economy. But I think the willingness in these borrowers to still be involved in these loans as opposed to just going delinquent, I think that is, I mean, maybe it's just generally something that people were very skeptical of over the last 5 years.
Yeah.
So I think that's really what we're trying to point at when we say that it's doing better than you would have expected. And I know that kind of gets lost in the mix now, but for many years, people thought that these loans were could default very quickly.
And I'd like to add one thing to that. One of the biggest concerns that the mortgage world faced during 2008 is that even though modification programs were set up, borrowers simply just weren't making contact. Like, servicers could just not ever get the borrower on the phone. It would be very hard to reach them to do anything other than appear in court. So the fact that already the vast majority of what we see in impairments are modifications, meaning that the borrower has reached out, they have made some contact, they have requested it, is saying that the borrower does want to engage with the lender and do some kind of resolution to their loan rather than just simply saying, I'm walking away.
Okay, great. So the next one, hi guys, hi. How do you think about CPRs going forward for the online loan segments? Does a slowdown in CPRs increase the loss on the remaining pool given the uncertainty?
So CPRs, I think, is one of those things that we'll wait and see. One of the difficulties about CPRs, of course, is that some of the refinancing activity that would occur in the sector is largely speaking, in some cases, abated. But that said, I mean, CPRs were typically still in the mid-teens in a lot of these cases, and these loans are fairly short duration in general. They're only about, the universe frequently breaks down between 36 and 60-month loans. And with the amortization schedule, a lot of the duration of the overall loan is about 1.5 to 2. So even with a slowdown in CPRs, so you're maybe talking about lengthening that duration by a few months. So overall, it doesn't necessarily indicate, like a slowdown in CPR wouldn't necessarily indicate a complete cratering of performance. But we will see. And the other thing too, of course, is that there's going to be a question about how much new loan origination is going to happen. So that's going to be that will probably be as much, if not a bigger function of CPR than the strength of the borrower overall.
Yeah, I would definitely agree with that. There was a question about performance delinquency behaving differently among countries that have different government measures applied, US versus EU countries. Most of this, I mean, all of this data set is US based. And I would imagine, just given what you've seen in the difference in performance across different states, I think, that would definitely apply at the country level.
Yeah.
But do you have anything you want to add to that, Vadim?
No, I think that's exactly right. And what we would caution is the fact that, in the US, we do have a fairly robust lending system outside the major banks. There are, transactional loans made by all different kinds of parties, as we see here. A lot of European countries are still run through the banking system in terms of lending. So the data transparency isn't there to the same degree that it is here. And that's something that we would definitely love to push for, changing at dv01. So we would love to see some more loans from non-US issuers up on our platform so we can actually highlight a difference in country behavior.
Yeah. So I thought this was an interesting one. Can you go into a little bit more detail as to why regional trends were different between online lending and the mortgage market? And I would just, before you dive into that, I would just, beyond just the cadence of the data that we have in mortgages versus online lending being different, so the representation of the market that we have for mortgages is a little bit different. It's not conclusive of the whole mortgage market. So if you are an investor in the non-QM space, I'm sure you're aware of the deals and the issuers that we have on the platform. Obviously, there's some that are missing. And if you'd like to see those deals up on the platform, I'd encourage you to reach out to those issuers. It shouldn't be a burden for them to get the data up on the platform. But Vadim, you want to dive into that?
Sure. So obviously the big caveat is in MPL, we are talking about trends through April 23rd versus trends through March 31st in mortgages, which is obviously a big factor here. The other reason is that the housing dynamics that we see out in, California, that we see out in the tri-state area, is pretty different than some of the dynamics we see all across the country. I think the significant shortage of housing in California And the fact that especially entry-level homes have been selling as quickly as they have been is a testament to just how strong that housing market overall is. The fact that California homes are sitting on something like $1.5 trillion of positive equity or more is another statement. So, the housing market in some of those regions have been, pretty substantially strong. And of course, in Florida, we've seen housing activity really, really pick up over the past 4 to 5 years. HPA has been very strong, and a lot of borrowers are again sitting on tremendous amounts of positive equity. So kind of knowing the fact that they could possibly lose their house is kind of changed their payment behavior from the previous crisis when so many borrowers were underwater to today when so many borrowers are sitting on equity that their house is so much more important to them than perhaps we were used to in the past.
And I think I'll take this opportunity to shamelessly plug one of our integrations with House Canary. So for any non-QM deals on the platform, in addition to just seeing the loan performance, we've mapped at the MSA level to House Canary's HPI index, and we've created updated MSA level LTVs for every loan. So I think over the next few months, that's going to be something really interesting to see, to monitor, to see how that's changing, as well as performance in these pools, to really get a better sense of what potential losses there might be on these deals.
And if anybody wants to have a further discussion of how we integrated House Canary or what the House Canary data represents, definitely reach out to us afterwards.
You talked about the impact that you've seen in mortgages. When do you think, at what point do you think we'll see the full picture in mortgages? What remit date is it really going to take? Is it the one that's coming up in May, or are we really going to have to wait into June?
I think in some cases we might have to wait to June. The reason being that, for example, in the CAS world of CRT, the data is actually lagged on a 1-month basis. So the latest report only represents February data. So we're not really going to get to see a clear picture of performance in CAS CRT, for example, till really June in some cases. And on top of that, what's going to be hard is if we ever looked at the hurricane regions in the past, the real cycle of kind of the ebb and flow, the initial spike and then the subsequent roll down in rates really occurred over the course of a year, with some of the initial spikes, of course, occurring in the first 3 or 4 months. Now, it's really early because, we haven't really seen any state exit quarantine yet. We're still seeing substantial measures being imposed, and we're still seeing new unemployment, claims pop up everywhere. So it's hard to say when we really see the full picture until we really see a stoppage, until we see a substantial slowdown in initial claims, until we have a handle on where unemployment winds up, and until we start to see, the economic activity and the economic picture change. And then we'll really start to see the full meat of this thing. On top of that, the other thing that's going to happen is in mortgages, you're going to see some initial payment forbearance on top of initial delinquencies, and that stuff will proliferate over the course of a couple of months. So really, I think June and July is when we'll really start to see the meat of the full kind of brunt of what we've been seeing, what performance is going to look like.
Okay. So in our conversations with the originators in online lending, what are the criteria that the platforms are using to provide modifications? For example, if online platforms are providing modifications in mass, it might take away from some of the signaling value of modifications. That is, a substantial proportion of these borrowers might actually need the modifications, which might just delay the inevitable poor performance of the borrowers. How do you feel about that?
Well, I mean, look, the anecdotes are always going to be that any borrower just wants to skip payments for a period of time. The reality is, again, there are no automatic enrollments. This is still something that borrowers have to call in and request. So, I mean, we can say 2 things here. Number one, we can harp on the fact that overall increases are significantly below the change in unemployment. And remember, that's just unemployment. There are plenty of people who haven't lost their jobs but have taken a substantial pay cut, or somebody like a self-employed borrower who perhaps couldn't even file an initial claim, but they've certainly borne the brunt of this. So far, we haven't seen impairments anywhere near what we've seen in unemployment, so that's a sign. And the other sign too is the same kind of behavior was applied by the issuers during the hurricane period, where if somebody really had, a crisis, they would call and they would say, my income is impacted because of XYZ economics. And back then, those loans then had 26% impairments versus almost 80% for delinquencies overall. So we can't say exactly whether every single borrower here is going to perform, but we can certainly say based on behavior we've seen before from these guys and based on how loan impairments have behaved thus far, we're not seeing those really worrisome trends that this is just all delaying the inevitable.
Right. And I think that's a good segue into the next report, right? What some of the main focus is going to be around looking at those first post-mod payments.
Yeah, in the next report, we're all absolutely going to be covering, as we showed in the previous slide, we showed the first week of modifications and how they're performing. We're going to get to see a couple of more weeks of that, and we're also going to see the first signs of the really large increases in mods, which were the end of March, early April period, and we'll get to see how some of those loans have performed. So we'll get a lot more clarity in that report.
Okay, and the last question that we got is, can you go into more detail on the different types of modifications, specifically settlement, re-age, and debt management?
Absolutely. We'll go back to the slide that we talked about here. As we said, over 90% of modifications are in that kind of, are in that extension, forbearance, and skip payment option. Some of the other plans that exist are, for example, if a borrower wanted to make a reduced payment due to a reduction of income rather than just overall haltage of income, they could seek something like a re-age, which would basically take the loan back to square one and re-amortize the remaining balance over the original term, which would substantially reduce your payment. Imagine a borrower that was 24 months into a 60-month loan, now going back to paying that same balance over 60 months rather than 36. That'd be about a 40% reduction in payment. Likewise, there are also some programs like an interest-only payment that can be offered to borrowers, or a temporary lowering of rate for a period of time until which the rate then spikes up. And some of those can go into the short-term assistance or settlements. And finally, if necessary, if the impairment is more of a long-term nature, then some mods we do see in the kind of form of a long-term assistance, which would be, again, a reduction in rate, permanent term extension, or something of that sort. And then, of course, there are some overall settlements, which is kind of a mixture of everything. But the vast majority that we've seen, not just historically where it's been about 70%, but today where it's been over 90%, is just that short-term stopgap temporary pause payment.
Great. If no one has any additional questions, which doesn't look like in the chat, that will bring us to the end of this, short and sweet. I just want to take this moment to again thank Vadim for taking the time, thank Wei for his contributions to the report as well, getting all the data together and getting in a position where we could talk about it, and the rest of the dv01 team. So please feel free to reach out if you want to chat about anything, in any greater detail. Everyone will be available to discuss this further. So with that, thanks for your time today. Have a great weekend, everyone.
Thank you all. Take care.